18 months. That's the window you have left to position yourself before the next economic reset begins. I'm Dalio. I founded Bridgewater Associates in my two-bedroom apartment in 1975, and today we manage over $124 billion. I've studied 500 years of economic history across 30 countries, and I predicted the 2008 financial crisis 18 months before it happened. I wrote about it in a report called The Coming Great Deleveraging that I sent to our clients in March 2007. Today, I'm going to show you exactly which three asset classes will not just survive, but thrive during the next phase of this debt supercycle, and why 97% of Americans are positioned in the exact wrong direction. The gap between those who understand what's coming and those who don't is about to become generational wealth on one side and catastrophic loss on the other. Only three assets. Everything else is a distraction or a trap. In 1982, I thought I had it all figured out. I went on Wall Street Week and I told everyone that we were headed into a depression. I was so certain. I had studied the debt cycles. I knew the patterns. Mexico had just defaulted on its debt in August. I saw all the warning signs that looked exactly like 1929. I was dead wrong. Not just a little wrong, catastrophically wrong. Instead of a depression, we entered one of the greatest bull markets in American history. I lost money for our clients. I had to let everyone at Bridgewater go. It was just me left. I had to borrow $4,000 from my father just to help support my family. I was 33 years old, humiliated, broke, and convinced my career was over. That failure changed everything for me. It forced me to question every assumption I had. It made me develop a system that didn't rely on being right about my predictions. Instead, I built a framework based on understanding how the economic machine works across all historical periods, not just the pattern I thought I was seeing. That's when I discovered something crucial. The question isn't whether you can predict the exact timing of when markets turn. The question is whether you understand which assets perform in each phase of the debt cycle and whether you're positioned accordingly. Since developing that framework in the 1980s, Bridgewater has had only 4 down years out of 42. That's a 90% success rate across 4 different economic regimes, 3 recessions, 2 major crises, and countless market corrections. Here's what you need to understand. We are currently in stage 7 of an 8-stage long-term debt cycle. I've documented these cycles going back to the 1500s. They last 60 to 80 years on average, and they all end the same way. We're not in normal times. This isn't a regular recession you can wait out with a balanced portfolio of stocks and bonds. The last time we were at this exact stage was 1944, right before the Bretton Woods reset. Before that, it was 1933, when Roosevelt took us off the gold standard domestically. Before that, it was 1789 in France, when they reset with the assignat currency system. The pattern is always the same. Stage 1 is the new order. Stage 2 is the peace and prosperity phase. Stage 3 is the bubble. Stage 4 is the top. Stage 5 is the depression. Stage 6 is the currency debasement and large deficits. Stage 7 is the most dangerous. That's where we are right now. This is when governments have massive debt burdens, when they can't raise taxes anymore without causing civil unrest, when they can't cut spending without defaulting on promises made to their citizens, and when the only path forward is to print money and devalue the currency. Stage 8 is the reset itself, the complete restructuring of the monetary system. Let me give you the numbers that tell you exactly where we are. The United States currently has $36 trillion in official government debt. That's 108% of GDP. But that's not the real number. That's just what's on the balance sheet. The actual unfunded liabilities, the promises we've made for Social Security, Medicare, Medicaid, and government pensions, that number is somewhere between $100 and $212 trillion, depending on which accounting method you use. Even if we take the conservative estimate of $100 trillion, we would need to set aside the entire economic output of the United States for 3 years just to cover the promises we've already made. That's impossible. It's never going to happen. We have 3 choices:
Default outright and break our promises, massively raise taxes, which would destroy economic growth and create social instability, or devalue the currency by printing enough money to pay the promises in dollars that are worth less and less. Every government in history at this stage has chosen option 3, every single one. Not because they're evil, not because they want to steal from savers, because it's the only politically viable option. Now, here's what makes this time different from 2008. In 2008, we were dealing with a debt crisis in the private sector. Banks and households had too much debt. The government stepped in with massive stimulus, dropped interest rates to zero, and absorbed the pain onto the public balance sheet. It worked, because the government still had room to take on debt. Government debt was 60% of GDP. Interest rates could go down. There was a playbook. This time, the problem is government debt itself. There's nowhere left to push the pain. We're already at 108% debt to GDP. Interest rates went to zero during COVID, and we still had massive inflation. The Federal Reserve's balance sheet went from under $1 trillion in 2008 to $9 trillion by 2022. They printed more money in 2 years than in the previous century. And now, they're stuck. If they keep rates high to fight inflation, they bankrupt the government, because we're paying over $1 trillion per year just in interest on the debt. That's more than we spend on defense. If they cut rates too fast, inflation roars back because there's too much money chasing too few goods. This is the trap. This is stage 7. There is no easy way out. So I've spent the last 5 years going back through history and studying every major currency devaluation and monetary reset. I looked at Weimar Germany in the 1920s. I studied the Roman denarius debasement in the 3rd century AD. I analyzed what happened in China in the 1340s when they abandoned paper money entirely. I studied Britain after World War I, France in the 1780s, Spain in the 1500s when silver from the Americas caused massive inflation. I built a database of 123 distinct currency events, and here's what I found. There are only 3 asset classes that consistently preserve and grow purchasing power during stage 7 and stage 8 of the debt cycle. Not 5, not 10, 3. Everything else gets destroyed or severely impaired. Let me walk you through each one and explain exactly why they work. Asset class number 1 is gold. Not gold mining stocks, not gold ETFs. Physical gold that you either hold directly or that's held in allocated storage where you own specific bars. Here's why gold works. Gold is the only asset that is nobody's liability. Think about that. A government bond is a promise from the government to pay you. A corporate bond is a promise from a company. A dollar bill is a promise from the Federal Reserve. Stocks are ownership in companies that operate in economies denominated in currency. Real estate is priced in currency and generates rental income in currency. Gold is just gold. It can't default, it can't go bankrupt, it just exists. And that matters enormously when you're in an environment where all the promises are being broken or devalued. During the 1970s, which is the best recent parallel to where we are now, gold went from $35 an ounce in 1970 to $850 an ounce in January 1980. That's a 2,400% return in 10 years. Meanwhile, the stock market was basically flat. Bonds got destroyed because inflation was running at double digits. Real estate did okay in nominal terms, but was mediocre in real terms after you account for inflation. Gold was the place to be. Now, here's what most people get wrong about gold. They think of it as an investment. It's not. It's a form of money that holds its value. The dollar price of gold doesn't really go up. The dollar goes down relative to gold. When people say gold went from $35 to $850, what really happened is the dollar lost 96% of its value relative to gold. That's the key insight. In stage 7 of the debt cycle, you don't want to be making promises to other people through bonds. You don't want to be holding promises from other people. You want to be holding the thing that is no one's promise. Central banks understand this perfectly. They've been buying gold at record rates for the last 3 years. China added over 225 tons to its reserves in 2023 alone. Russia, India, Turkey, Poland, Czech Republic, they're all accumulating gold. Why? Because they know what's coming. They're preparing for a reset where gold likely plays a role in the new monetary system, or at minimum acts as a confidence anchor. You should be doing the same thing. I recommend holding 10 to 15% of your liquid net worth in physical gold, not as a speculation, as insurance that never expires. Asset class number 2 is inflation-indexed bonds, but only from governments that don't have runaway debt problems. This is crucial. Not U.S. tips. U.S. Treasury inflation-protected securities sound good in theory, but they have a fatal flaw. They're denominated in the currency that's being debased. Yes, the principal adjusts for inflation, but you're still stuck holding dollars at the end. If we get a currency...
Now, let me give you the exact implementation plan. Month 1. This is your assessment and positioning phase. You need to calculate exactly where you are right now. Take out a sheet of paper or open a spreadsheet. Write down every asset you own: stocks, bonds, cash, real estate, retirement accounts, everything. Next to each one, write down what percentage of your total net worth it represents. Now ask yourself this question for each asset. If we enter a period of 5 to 7% annual inflation combined with a 20 to 30% decline in the dollar's international purchasing power, does this asset protect me or hurt me? Long-term government bonds hurt you. Cash hurts you. Stocks are mixed depending on the company's pricing power and debt levels. Real estate is mixed depending on location and debt. Gold protects you. Foreign inflation-linked bonds protect you. Productive real assets in good locations protect you. Most people, when they do this exercise, realize they're 90% exposed to dollar debasement and only 10% protected. That's backwards. You want to be at least 40% protected, ideally 50 to 60%. Month 2 and 3. Start making the shifts. This isn't about panic selling everything. It's about systematic reallocation. If you have long-duration treasury bonds or bond funds, start moving out of those positions. You're going to take a loss if rates have already risen, but it's better to take a controlled loss now than a catastrophic loss later. If you have a large cash position, that's dead weight. It's getting debased every single day. Keep 3 to 6 months of expenses in cash for emergencies. Everything else needs to be working for you. Start building your gold position. You can buy physical gold through reputable dealers like Apex or JM Bullion. If you're buying larger amounts, you want allocated storage through companies like Brinks or Viamat, where you own specific bars. Don't use unallocated pool accounts where you just own a claim on gold that the company holds. That's a counterparty risk. In a real crisis, you want to own the actual metal. Start with 10% of your liquid net worth. If you're comfortable and the situation deteriorates, you can go to 15 or even 20%, but start with 10%. Get that base position in place. For the foreign inflation-indexed bonds, this is more complex. You can't just log into your normal brokerage and buy Australian linkers with a click. You need to either work with a broker that has international capabilities, use ETFs that hold baskets of foreign inflation-linked bonds, or open accounts with foreign brokers. I'll give you the practical path. There's an ETF called WIP, the SPDR Bloomberg International Treasury Bond ETF, that holds inflation-linked bonds from multiple countries, including Australia, Canada, and the UK. It's not perfect because it has currency hedging, which removes some of the benefits I talked about, but it's a start. Better option, work with a wealth advisor who can access international bond markets directly. You want to build positions in Norwegian, Australian, and Canadian inflation-linked bonds. Spread your allocation across the three. Target 20 to 30% of your portfolio here. This is your real yield plus currency protection layer. It's not going to make you rich. It's going to preserve your purchasing power and give you positive real returns when almost everything else is getting destroyed.
18 months. That's what I said at the beginning, and that's what I mean. I'm not saying the currency reset happens in exactly 18 months. I'm saying that's the window you have to get positioned before the acceleration phase begins. We're already seeing the early signs. Gold hit all-time highs in 2024. Central banks are diversifying away from dollars at the fastest pace in 50 years. The BRICS nations are building alternative payment systems. The petrodollar system is fragmenting, with Saudi Arabia now accepting yuan for oil sales. These are not random events. These are the precursors to Stage 8, the actual reset. When that happens, you don't want to be the person scrambling to figure out what to do. You want to be the person who positioned 6 months or a year earlier when there was still time to make calculated decisions. Here's your action plan. This week, do your assessment. Write down everything you own and calculate your exposure to dollar debasement. Next week, open the accounts you need to implement the strategy. Find a broker who can access international bonds. Set up an account with a gold dealer. Research the farmland and timberland platforms. The next week, start making your first moves. Buy your initial gold position, make your first investment in foreign inflation-linked bonds. It's not complicated, it just requires you to do something different than what 97% of people are doing. The time to act is when things still seem relatively stable. When everyone is panicking, it's too late to get good positions. You're buying at the top of fear instead of the bottom of complacency. I've been doing this for 45 years. I've managed money through stagflation, through the dot-com crash, through 2008, through COVID. I've seen leaders come and go. I've seen monetary systems evolve. The one constant is this: the people who understand the big cycles and position accordingly build generational wealth. The people who ignore the cycles and stick with conventional wisdom lose. We are at one of those pivot points right now. You have a choice. 3 assets: gold, foreign inflation-linked bonds, and productive real assets in good locations. Everything else is secondary or unnecessary for the next phase. Position yourself now. Your future self will thank you.